Hello, everyone. Thank you for joining us and for joining us over your lunch hour. We're going to wait for just a few minutes more to let everybody roll on in and join us. I know everyone's probably heating up their lunches. I just finished mine, so we're all in the same boat here. But while we wait for folks to join, I'm just going to go ahead and do a little bit of some housekeeping. So welcome again if you're just joining in. We're just waiting for a little bit more people to join and let people log on. I am joined here by Nancy Patton through Canvas Credit Union, and we're really excited to have you all join us today for our Young Alumni Series Risk or Reward event with Canvas Credit Union. So as we're watching some housekeeping things here, we are going to be accepting comments and questions via the comments feature on YouTube. That is either visible underneath your screen or right to the right side of it. It varies depending on where you're watching at it. So if you want to go ahead and practice, like I'm going to do so right here, go ahead and put in the comments where you're watching from and what year you graduated if you are an alum. So for instance, I think mine's working on posting there, but Sophie Matthews, she, her pronouns. I'm the Student and Recent Graduate Engagement Specialist for the CSU Alumni Association, and I am watching from the Smith Alumni Center in Fort Collins, Colorado, so right local here. Couple other things as we're going ahead and practicing if you want to. I just want to take a moment to thank our CSU Alumni Association members who are joining today or who may be watching this after the recording. Membership really makes everything that we do here at CSU possible. It makes our events like this, our career and professional development, as well as many other things that we have possible. So just want to thank everybody for joining and for your support. Last but not least, I just want to mention that the recording of this video will be available immediately here. So on this same window that you're on our CSU Alumni Association YouTube channel, it'll be available immediately after the event ends. So if you feel like you want to watch it again or you missed something, you'll have it immediately after the event. And again, for those who are just joining, we are going to be taking comments and questions via the comments feature. So right underneath your screen where you're viewing us here, there should be a section to type a comment, or there is also space available on the right side of the screen in order to do that. And if you aren't available to send comments that way, I will also be dropping my email in the comments so that you can see it and you can send me any questions or comments you have along the way, and I'll make sure that Nancy has access to those. Okay, awesome. Well, now I am excited to introduce you to our guest speaker, Nancy Patton from Canvas Credit Union.
Oh, that's it. Hello. Thanks everybody for signing on to join us to discuss risk and reward. It's a conversation about some various options that you can plug into with your investment dollars, and then how that might fit into your financial future. So our risk and reward seminar is going to discuss several basic investment concepts in light of 3 specific ways you could invest your money. We'll begin with general comments about things like diversification, risk, priorities, some definitions, and then we're going to dive into the specifics about 3 particular investment options. We'll start with a really common way people start investing for the future, and that's using a plan that's available to you from your employer. And then when we start to think about some riskier or some non-traditional alternatives, there are so many options. There are lots of different ways you could try to earn more with the money you have. We're going to talk just about 2 specific ones: collectibles and cryptocurrency. And for all of these things that we've mentioned, we're going to follow the plan of discussing what it is, how it works, the pros and cons, and then give you resources so you can do further research on your own. I do need to mention that, I'm not an investment advisor. I don't sell cryptocurrencies. I don't have an appraiser's license, so I'm not going to be able to tell you how much your baseball cards are worth. This is just a general overview from a financial educator about options that exist when you're looking to try something for your future financial benefit. Okay. So let's start with some of those general comments, concepts, definitions. Let's talk about that. An investment is simply something you put money into now, hoping for a larger return in the future. People commonly think of stocks, bonds, mutual funds when they think about investing. If you buy stock, you're investing in a single company like Starbucks. A bond is when you loan money and then are paid back at a specific interest rate. Some common things that you might you find when you're using a bond as an investment is that maybe you're loaning money to a city government and they're going to build a water treatment plant. Maybe the bond is for a school district to have the money to construct a new school. So that's a bond. You're helping by loaning your money out. When you put money in a mutual fund, it lets you buy into multiple companies instead of a single company, like the stock example in Starbucks. Now you're buying a financial institution, you're buying maybe oil and gas, you're in Walmart, a retail operation. So you're spreading it out over several companies. Many people like to mix up what they're investing in and try some alternatives. And so that could include all kinds of things, like owning your own home as an investment, maybe having a rental property, being a landlord. There are precious metals available, gold, silver, platinum you can purchase. Maybe you know a friend or a relative and you trust them and they're starting a business and you're going to give them early funding, sort of an angel investor. And in return, you'll either be a part owner in the business or you'll get a portion of the profits. All of those kinds of things have various levels of risk, how easy it is to access your money, and tax considerations. So if you consult with a financial advisor, which we heartily recommend, then they're going to help you explore your overall financial picture and maybe help you find an investment you're comfortable with. So you can see some of the considerations on the screen here that go into choosing both traditional and alternative investments. Your risk, your timeline, diversification. We're going to dive into each of these in just a second here. So a really basic review of your financial picture is going to include what's your risk tolerance. And the theory is that with higher risk comes higher reward, more earnings, but it also can come with higher losses. So what may be fine for your brother or your neighbor to put their money into may not let you sleep at night. How soon do you need to see your money grow? Do you have 5 years to wait, or is it 45 years? What are your goals? Some common goals are to have money for kids to attend college and money for retirement. But maybe your goal is to have money so you can take a 2-year sabbatical from your job and go on some kind of worldwide adventure. You need to be thinking about what your timeline is, what your goals are. And then there are so many ways to diversify where your money is going to be invested. And as you consider options, another part of your analysis needs to be the costs associated with that kind of investment. Are there ongoing fees? Is there just a fee when you get started? If you buy something like fine art as an investment, are you going to have a security system? Maybe you have to increase your insurance coverage. Some other considerations include deciding how active you want to be in managing this investment. Is it a set it and forget it, or is it a daily management thing that you want to try? And then, have you set a limit on the amount of money you're going to invest in each option? Knowing how much you can risk in one area will really help you not to exceed that amount, not to get caught up in the moment and spend more than you can afford to invest. And finally, you really have to consider your overall financial position. And we're going to talk about some things that you keep in mind with that. Financial experts are going to suggest two foundational things to make your financial life be successful. One is to set aside savings, and the other is to use a budget. There are some other basics that you really need to have in place for financial well-being, and those include a strong credit score, adequate insurance coverage, and smart debt management, like using the snowball plan to reduce your debt. At Canvas, we often see people that are anxious to invest for the long term, but unfortunately, they haven't got some of these basics in place. Investing money without having these financial foundations set up can end up costing you more. So an example of that would be if your car breaks down and you have to access your investments to cover the repair. It probably incurs a fee or maybe a tax expense. Another alternative in this situation is putting the repair on a credit card, but credit card interest rates are running about 25% right now, and that can be really expensive and very frustrating. So before you plug into any kind of investing, please make sure that you have your financial foundation in place and that you're not going to put your money at risk by these future investments. So those that's an overview, a thought. But I ran into some quotes from a variety of people, some from quite a while ago, Mark Twain, some sort of our contemporaries, Peter Lynch, and some others. So let's just take some advice for a second from some other people. I loved Peter Lynch's comment about not investing in something you can't illustrate with a crayon. Another way to explain that is never invest in something you don't understand how it works. And I actually fell for this once. We did invest some money in something and I thought I understood it, but I really didn't. And it ended up being a scam. So a word of caution. And then I loved Mark Twain's comment about being speculative with your investing. The funny comment, about mine just waves goodbye. And then Warren Buffett, we're familiar with, of course, in a contemporary investing guru, and his comments about avoiding the dumb things. So I'll let you ponder some of those, and we will jump into this first option we have for our investing our money for the future, and that's employer retirement plans. So far, we've really just set the stage for looking at money wisely, but let's dig a little deeper into this particular one. So I have mentioned that the financial world changes, things change, economics change, and the employer plans are one place where changes have definitely occurred compared to the past. At one point, pensions were the common employer retirement plan, and now it's seldom a pension plan that's offered to you. Now it's probably a 401k or one of the similar programs. 401ks used to only be available as a traditional tax structure, but now there are Roth options. I was just talking with someone the other day, and he's got money going into both a traditional 401 and a Roth 401. And those are going to help with the tax considerations. Profit sharing still happens, and profit sharing is considered an employer plan. Just a comment about the distinction between a pension and a 401k is that a pension is considered a defined benefit, while 401 plans are defined contributions. And then there's the tax treatment of all these funds, which can be different. We all know that tax is going to have to be paid, but when do you pay it? So depending on your situation, it may make more sense to choose to pay your taxes when the money goes into the investment, or to pay your taxes when the money comes out. And then this is not technically a retirement plan, but health savings accounts are increasingly common. And if your employer offers the option of having high deductible health insurance, that means that when you have high deductible health insurance, you could have a health savings account. And this might be worth researching whether it's a good way for you to set aside money for your future. I know that my CPA recommends this. I know that our family's had good success using a health savings account. So definitely worth research if that is an option for you with your employer. So those are what an employer plan is, but now how do they work? Since the majority of the current plans are defined contribution plans like a 401k, or if you're in a government job, a 403b, that's what we're going to focus on today. The details vary by employer, but here's some basics so that when you begin working at a company, you'll find that their employer plan either is set up so that you have to choose to opt in and participate, or that the default is that you're going to participate and you have to opt out. So that each employer can set that up. Each employer is going to decide if they offer any matching funds to the money that you deposit. And they're going to be able to choose how much that's going to be. And this can change as economic conditions change. I know of an employer locally here where for a while they were matching money, and then times got tough financially in that particular industry, and they had to stop their employer match. So this can change, but you'll find out about that as you work with your current employer. And then the employer sets the vesting schedule, which is how many years you have to be with the company before their matching funds are available to you. Your own money that you put on deposit in the employer plan, that's yours, that's there. But the matching funds often require you to work for a certain number of years before the funds are available. So they also may have the ability to automatically increase your contribution over time and make it super easy to increase what's going in. There may even be an option for you to borrow funds with a loan from this retirement account. The employer takes the contribution amount you've chosen directly from your paycheck. And often there's an advisor available to you for a free consultation about what's going on with your plan, what's happening with the market. Do you need to switch things up? So you can often consult with someone for free. But when you're setting up your plan, you decide how much of your contribution is going to go to various kinds of investments. And so those are the basics about how those employer plans are set up and work. Here's some of the pros and cons that go with this option. Because of how these plans are set up, there are some sort of inherent pros and cons. Two of the biggest advantages are just how easy they are to use, and of course, free money from your employer. So we actually once talked, we were working with some students, high school students, and they couldn't understand why an employer would give you money for your retirement. As employees, as adults, we understand that employers want to keep us around, and that this benefit of contributing to your retirement fund is a great way to have employees stick around. So the disadvantages are listed here as well. They are mostly about the limitations that exist because of how this is set up. Whether it's that vesting schedule or the fact that there may not be as many funds available as you would like to try. But I think the biggest part about employer plans are how easy they are, and then that matching money that comes with it. So some things to consider if you are already in an employer plan, or if you just haven't jumped into that yet and you're thinking about signing up for that. There are some resources listed on the screen to help you dig into this topic further. We highly recommend Investopedia for any terms that you don't understand, any definitions you need to get. So feel free to research, plug in any word that you don't understand. You can type in entire sentences. How do 401ks work? Just Investopedia, we're pretty impressed with. And then you may have access to a personal financial advisor, or through your employer. Your employer benefits department should understand some of these options and be able to help you. And then, of course, the website that's associated with your pension or your 401 provider. There's also a government site called investor.gov. It just has general information about the concept of investing. And then there are some great calculators on there that are going to help you match up your goals, your timelines, and your budget. So some researches to go a little deeper on employer plans. Let's switch over and talk about our next option for investing, and that's buying collectibles. What are collectibles? It's a physical asset that appreciates in value over time because it's rare or it's desired by many. So maybe you're already collecting something. Probably it was for fun, not as an investment. I don't know if you heard the recent story about a man from Washington who had a massive collection of Star Trek items. As a kid, I collected postcards from our travels around the country, and they're still in a box down there in a closet, but I'm pretty sure they have absolutely no value. You hear stories, of course, about the Goodwill painting that you purchased for $10, and it turns out there's some amazing masterpiece underneath it. Or the baseball card in the attic that was worth thousands of dollars. But most people actually collect things for pleasure, or it reminds them of their childhood. So the American girl dolls were popular in the 80s and 90s. Just a variety of things that maybe trigger something in your childhood, and you think it would be fun to have a collection of those. Oh, and maybe it would make you some money besides. So collectibles are considered an alternative investment, partly because their value is extremely variable. So I'm going to talk about a particular coin as an example. My mother left me some silver dollars. The oldest one is from 1889. So a very old coin. In spite of it being so old, there actually are lots of them around. And mine is in very poor condition compared to some others that are available. So one of the things about my silver dollar is that it is real silver. So it actually has some value as a metal, but not much value as a collectible. So I'm in comparing online values for an 1878 Morgan silver dollar. So I just typed in one particular coin. And do you know that I came up with values ranging from $60 to 47,000? So just with that one item, we can see how having a thing, whether it's Star Wars figures or baseball cards or dad's stamp collection, it just can have tremendous variability in its value. One note on that, for a lot of collectible items, the earlier version is worth more than a later version. So let's think about Star Wars, those early toys that came out, they're going to be more valuable than a recent item that was distributed through the Star Wars franchise system. Yes, you know what I mean. So one key bit of advice regarding collectibles is to collect something that brings you joy, not necessarily something you're counting on for financial value. Certain collectibles can appreciate significantly over time, and that's why they still are used by people as an investment. And sometimes they actually outpace traditional investments. However, knowing which of those items are going to do that can be very difficult to predict. So collectibles are physical items. You can see and touch them, and that might provide a sense of security or satisfaction that personal assets don't give you. Investing in collectibles can be enjoyable and fulfilling if you have a passion for the items that you're collecting, whether that's sports memorabilia, vintage toys, worthless postcards. But this can make the investment process more engaging, less successful, maybe even feeling like an adventure as you hunt for that next object in your collection. Collectibles can add a layer of diversification to your investment portfolio, potentially reducing overall risk, and they often have a low correlation with traditional things like stocks and bonds. Some collectibles, like fine art or precious metals, can act as a hedge against inflation because they maintain their value even if currency declines. Some collectibles can be integrated into your everyday life. Maybe you display them like artwork or wear them like jewelry. Some of the items that people collect are actually part of a family heirloom, a family heritage, a family tradition, and that can add additional meaning. One of the great things recently is that with the possibility of global sales through virtual sales, you can actually increase the ability to find an interested buyer. And compared to having to find a local buyer for the item. So then some of the cons that go with collectibles, they can be difficult to sell quickly. Even with the global market, finding the right buyer who has the price and that can take the time it takes to market it and then ship it off safely. So it can be time consuming to sell the item so that it's not very liquid. Determining the true market value can be complex and subjective. Prices really can vary widely. Proper storage and maintenance of collectibles can be costly or time consuming. So, I mean, like stamps, coins, artwork, they need to be preserved in specific conditions to maintain their value. The collectibles market can be highly volatile, and it's influenced by trends and consumer tastes. And we never really know where that's going to go, what the current fad is. So what's popular and valuable today may not be tomorrow. Beanie Babies is a classic example given over and over again of something that was hot in the moment and really is not valuable now at all. Unlike stocks that pay dividends or real estate that could generate rental income, collectibles don't have any kind of income stream, and their value is only realized when you sell. Buying and selling collectibles often involve significant transaction costs. Maybe there's an auction fee or a commission involved. And unfortunately, the market for collectibles is rife with fakes and forgeries. So verifying the authenticity of an item can take expertise. And we've even heard of museums being fooled about the authenticity of something that they've purchased. So, and finally, profits actually from the sale of collectibles qualify for capital gains tax. So, just a wide variety of reasons why you would choose or not choose to invest in collectibles as part of diversifying your investments. They can be a lot of fun, but they definitely have some downsides as well. So if you're curious about this option, there are some sites listed that will help you find the value of what you already have or what you're considering purchasing. There's certainly a library is going to have some excellent resources about a specific area of collectibles. And then the appraisers are listed there. If you need to find the true value of something, you need to pay a professional for it. It definitely has some challenges, some risks that go with it, responsibilities of how you store the item, that incredible volatility of what something is worth. So it's really essential with collectibles to do your research, seek expert advice, and then be sure you're preserving the collectibles to potentially maximize the investment that you're looking for. As we hop onto our last topic, the cryptocurrencies, this is a relatively recent addition to investing options. And the variations and nuances of cryptocurrency means we can't possibly explain everything in this little seminar, but we're going to cover general concepts, go over how it works, and then again, provide resources for further research for you to do. What is a cryptocurrency? According to Investopedia, it's a form of digital asset based on a network that's distributed across a large number of computers. So this decentralized structure allows cryptocurrencies to exist outside the control of government or central authority. The first cryptocurrency was Bitcoin in 2009. There currently are about 23,000 cryptocurrencies available. Some of the better known names are, besides Bitcoin, Ethereum, there's something called BNB, Solana, Tether, Cardano. So again, 23,000 different kinds of currencies. Cryptocurrencies get labeled different ways. We think of them as a form of money. The IRS treats them as a financial asset or a piece of property for their taxing purposes. And just recently, in July, 1 year ago, in the United States, the courts ruled that cryptocurrencies are considered a security if they're purchased by an institutional buyer. But if someone like you, a retail investor, purchases on the exchange, then that is not considered a security. So the legality, the regulation, the taxation, all of these things vary from country to country. Individuals like you would buy currency via an exchange. So there is a common, well-known exchange called Coinbase. You could use an investment broker. You could use an app like Cash App. And once that cryptocurrency is purchased, it's kept in a digital wallet, or on a crypto exchange. Again, Coinbase is a very well-known one, and there's one called Kraken and Binance. So Binance, I bet it's Binance. So this is, again, we're looking at what is this? And so those were some basic definitions looking at what it is. Let's switch over to how it works. I think it's fascinating that technically anyone could create a new cryptocurrency. But since our focus is really on how crypto can be used as an investment, we'll discuss some key concepts related to common existing currencies. And depending on the type of coin, the new currency is created either by a process called mining or something called proof of stake. Bitcoin uses mining, but BNB and there's some others that use proof of stake for their creation. As a currency moves from person to person, as it moves around, it uses some really important technologies. The first one is blockchain. So blockchain is a public ledger containing all transaction data from anyone who uses the currency. The transactions are added to blocks, and then they're added to chains in a linear chronological order. And that makes it really difficult to alter a previous transaction, and it provides a very high level of security. So in addition to the blockchain technology, cryptocurrencies are decentralized, and they're not controlled by any single entity like a bank or a government. And this is achieved through a network of computers that validate and record transactions. So additionally, cryptocurrencies use some very advanced techniques to secure transactions and to control the creation of new units, as well as verify the transfer of those assets. So individuals can use cryptocurrency for purchases, and a surprising number of companies accept payment by cryptocurrency, including Amazon and Starbucks. When considering crypto as an investment, there are several ways you could go about that. You can buy cryptocurrency directly, or you could invest in companies with a partial or total focus on cryptocurrency. Some options might be a cryptocurrency mining company, the mining hardware makers, or support companies for the industry. Another option is to buy cryptocurrency-focused funds. So if you don't want to choose from among individual cryptocurrency companies, you could invest in a cryptocurrency-focused fund. And you have a choice of exchange-traded funds, and that includes index funds and future funds, and a range of cryptocurrency investment trusts. So multiple ways that you can plug into the world of cryptocurrency as an investment option in your portfolio. So there are advantages and disadvantages, just like all the other investment alternatives. The advantages of cryptocurrency include some things like it's cheaper and faster than other money transfers. Cryptocurrencies like that have been around a long time, Bitcoin, Ethereum, they've seen significant price increases since their inception and have given substantial returns for early investors. Because they're decentralized, cryptocurrencies are less susceptible to government interference, inflation, or a system, it doesn't collapse at a single point of failure. Cryptocurrencies can be traded 24/7 on various online platforms, and that can provide greater flexibility compared to the traditional stock market. And the blockchain technology ensures that transactions are secure. So there are some disadvantages, of course, as well. Cryptocurrency prices are extremely volatile, and significant price swings occurring over short periods, which can lead to substantial losses if you need to cash in during that time. I did just a smidge of research today. The current price for Bitcoin, a single Bitcoin, is 57,500. In 2021, it had a huge volatility, both drop and rise. I compared that to Amazon stock. Amazon price of a single stock right now is $200. And it was interesting, although Bitcoin had a rough 2021, Amazon didn't, but Amazon had a rough 2023 with that volatility happening for Amazon during last year. So again, cryptocurrency price is very volatile, significant price swings in short periods of time. So something to consider as you're looking at this. Another concern for many people is that mining requires extremely high energy use, mind-boggling energy use. So therefore, it has an associated cost, and actually there are complaints about noise pollution near companies that are doing cryptocurrency mining. They've become a popular tool with criminals. And whether that's something nefarious like money laundering or illicit purchases, they've also become a favorite of hackers who use them for ransomware and many fraud schemes. And we see this on a daily basis at the credit union. Many fraud schemes require the victims to send funds via cryptocurrency ATMs. So there is that uncertainty, that hesitation regarding the illegal use of this. Cryptocurrencies do operate in sort of a gray area in many jurisdictions, so there can be some uncertainty about future regulation, and that might impact their value or their legality. Although the cryptocurrency blockchains are very secure, there are some other parts of the process like the storage, exchanges, wallets that have had security issues. They've been hacked, sometimes resulting in the theft of millions of dollars in coins. And unlike traditional bank accounts or investments, cryptocurrencies are not insured, and any loss due to theft or fraud likely won't be recoverable. So despite growing acceptance and popularity, cryptocurrencies really aren't widely used for everyday transactions, and that might limit their practical use. So those are some pros and cons to consider about cryptocurrencies. I promised some resources. Look, Investopedia is there again. You can just plug in any term, any question into Investopedia and see how it comes up with it. It'll often have related links to the articles going deeper, taking you on a new angle off of the main topic you plugged in. Highly recommend Investopedia. Partly because cryptocurrency comes with so much new terminology and technology. So another resource is the consumer site, Federal Trade Commission, and that can have some information for you. The CFPB, the Consumer Financial Protection Bureau, also has some information about it. Libraries, again, are going to be a resource with books and other articles, research that you can do. We really do recommend that you explore more about this topic. It's an innovative financial technology, and it can offer unique investment opportunities. However, it does come with significant risk, high volatility, regulatory uncertainty, definitely scams, hacks, bugs, security challenges. So as with any investment, And especially for new users, it's really crucial to research and understand what you're investing in, to consider your risk tolerance, and to diversify your investment portfolio in a way you're comfortable with. Today, we focused on three different kinds of investing: employer sponsored plans, collectibles, and cryptocurrency. It is really important to have your financial foundation of savings, budgeting, insurance in place before you start investing. And then how does your personal timeline, your goals, your risk tolerance, how does that all fit into choosing from these options? There are so many: stocks, bonds, mutual funds, precious metals, being an angel investor, being your own small business owner, being a landlord, jumping into collectibles, cryptocurrency. There are so many options that come, all of them with different risk and reward. So we encourage you to do extensive research to find out how to use your money wisely as you invest for your future growth. And we just want to thank you today for joining us. We'll hang on for a minute and see if anything pops in. Sophie, have you had anything that we need to address?
Nope, I just want to give you a big virtual round of applause, Nancy, for hopping on here today and chatting through it with us. Wanted to thank everybody for joining us. And again, another big thank you to Canvas Credit Union and our CSU Alumni Association members. If you have a moment to fill out the post event survey that you will be receiving via email, your feedback would be greatly appreciated. And again, if that link isn't working, you're always welcome to reply directly to that email. But I hope you all have a great rest of your day. We'll hang on for a little bit longer. And last but not least, go Rams.
Absolutely. I forgot to mention I am a CSU alum, but from a really long time ago, I wasn't about to share my graduation date.
Awesome. Well, it looks like we've got two more people who are hanging out with us. So if you all have questions, feel free to let us know. And if not, then I hope you all have a great rest of the day and we'll see you at the next one.